Higher for longer as the Fed continues to tackle inflation, or at least try to. Point number two kind of aligns. Our PPI, producer price index number, agrees with that CPI and is in alignment.
Yeah, so let's think about the PPI, the producer price index, as the wholesale version of the CPI, right? So as consumers, as individuals, when we go buy something, we really think about the consumer price index. How much more are we paying for something? The producer price index, remember, the companies that provide the products that we consume, they have their own expenses, right? And so they track their own inflation rate. And so the PPI is really like the wholesale version of the CPI. And in general, what that means is that a higher PPI means a higher CPI is on the way. And that might sound complicated, but it's really easy to explain. When the costs for manufacturing an item rise, you can expect that if a company is spending more to manufacture that item, that a month or 2 months or 6 months down the road, as consumers, we're going to see those higher expenses in the prices that we pay. Now, this week we got last month's PPI as well as the CPI, and that was up 0.3% from last month versus expectations of 0.1%. This matters for two reasons. One is this is a big increase. 0.3% in a month is a big one, and the core PPI, again, excluding food and energy, was an even bigger surprise. That was up by 0.5% versus last month, which was way above expectations for 0.1%. If you want to know why that matters, it's because a 0.1% gain annualizes to 1.2%, well below the 2% target. That 0.5% monthly gain annualizes to 6.2% because there's compounding. That's why it's not 0.5 times 12. It'll be a little bit higher, so 6.2%. So one of those, what was expected, is something that was well below the target. What we got is a disaster. Inflation above 6% is a huge problem for the Federal Reserve. It's a huge problem for consumers. It's enough that, governments will change hands over that. The other reason this matters is because the prior month, the PPI was actually down. We actually had deflation. And so there was hope that with manufacturers' prices down versus the prior month, that we would start to look at decreases in the CPI coming down the road and that everything was really under control. So a month ago, that was something that led people to think, hey, maybe the Fed can reduce rates. In a situation where the PPI, instead of 0.1%, you get 0.5%, or instead of 0.1%, you get 0.3%, whether you're looking at the core or the regular. These are big differences. And so the conclusion here is, everybody say it with me, higher for longer, right? The Federal Reserve, looking at these numbers, is not about to reduce rates.
Higher for longer, higher for longer. We've been hearing that, saying that, and that is going to continue as a constant theme on this DKI 5 things.
Yeah, and the thing I would add to that, all year, the market has been expecting 6 Federal Reserve rate reductions. Each reduction is 25 basis points, which is 0.25%. So what people were expecting throughout this year was a decrease of 1.5%, 6 times 25 basis points. And Rob, how many times have we been on this particular show, this particular the 5 things video version, and we've simply said, take the under. There is no way in the world the Federal Reserve reduces rates 6 times in 2024. It's looking like we're going to be right on that. At least it does now. We can change our opinion later.
Get those bets locked in. Call the bookies immediately.
Yeah, exactly. Your Federal Reserve bookie.